Hi, Joe Lopresti here with the latest Arlington Wealth Management Proactive Strategy Update. Today's Friday, May 5th. Market action since our last update I would best describe as somewhat lackluster, erratic, kind of like a car that just can't get into gear. We get some decent up days and some down days as well. The bottom in the market that occurred last October has seen some lift up off that bottom, but it's stalled out over the last few months. And in an update, actually a written one that we put out over the Easter weekend, we said that we really wanted to see three things develop to break the market out from these kind of doldrum, lackluster type of trading. The first was we want to see key resistance levels taken out. That has not happened yet. We wanted to see the breadth of the market expand, the number of stocks participating in this rally expand. That has not developed the way we'd like to see it. And finally, we wanted to see some of the economic headwinds dissipate. And we're not seeing that either. In fact, we'll give you our latest update with our recession warning models, and they remain pretty fairly depressed levels you're going to see. From a cycle perspective or seasonality perspective, things were looking pretty good there. That bottom in October last year, we've shown statistics around midterm election years. We tend to get severe downturns just like we got last year. We tend to get bottoms prior to the election. Again, that came right on cue in mid-October. And then you tend to get significant recoveries in the market. Well, we did get a good recovery in the fourth quarter last year, as well as some follow-through in the first quarter this year. But again, things have stalled out, and we want to see some things come back into place to really push the market forward in this uptrend. So let's take a quick look at our PAS dashboard. We could see that not a lot has changed, although we did get the cash comparison status to shift back to negative. There's just some minor movements taking place there that are causing the move from negative to neutral back to negative again. It's not a concerning move, but nonetheless, we do want to monitor all these indicators. They wouldn't be on the board if they weren't important. We did get our latest read at the end of April with the long-term momentum indicator. It continued to be positive. We're going to take a look at that in a minute. And the universe trend indicator continues to be neutral. And this is the one that we kind of think holds the key here. This measures the breadth of the global markets. There's more than 4,000 stocks in that indicator globally, and it calculates the percent of those stocks that have positive trends each individually in their individual charts. Let's start out by looking at the universe trend indicator. So here are the two charts. We run two versions of them. One's a logarithmic and the other is a traditional scale, which refers to the individual stock charts and how we determine whether the trends are positive or negative for the 4,000 stocks. And you can see the percentages up here are straddling the 50% range, or roughly half of the universe positive trends, half negative trends. But what we've noticed is the progress has stalled out. So we had the bottom in October, that's the O column, showing the decline. Started to lift off in November, December, January, February, and then it hit 58% and it stalled out. Current numbers around 56%. So we'd really like to see something like 60% to show that we're getting some expansion in the number of stocks participating in this uptrend. And at least so far, we're not seeing that. It could still develop, but right now it's very neutral, I would call it. With the traditional chart, we actually hit 52%, and it reversed down during the correction in March that surrounded some of the bank failures. That news really hasn't gone away. Another bank, a regional bank, was handed over to JP Morgan this week, First Republic Bank. So we'll see if that banking crisis continues to spread and if that creates some additional issues down the road. But the point here is we're just not seeing the type of breadth that we would normally be seeing if we're in a healthy recovery of a bear market. Right? So last year's market decline was pretty severe. We're going to take a look at just how far the market indices dropped and how they've recovered and how much we're still off the high in a little bit. And now the recovery, just from a number of different measures, seems to be running out of a little bit of gas here, and we'd like to see some evidence that it's beginning to lift off again. Let's move over to our long-term momentum indicator, and you can see positive once again. So now we have a couple of months in a row where it's been positive. So coming off of the bottom in October, of course, it was negative momentum, and it turned positive as we got into the early part of this year. And the correction again in March caused it to move back to neutral. That's the little white background on the chart. And now for 2 months, it's been positive. So you can see the momentum down here is beginning to lift up. Of course, you would expect to see that with a recovery in the market. You know, the latest number on the momentum is a negative 124, and it got down to negative 170-ish or so, which is pretty low. In fact, this is a 10-year chart. That's the lowest it's been in the last 10 years. So another way of saying we just experienced one of the more significant bear markets in the last 10 years. If we expand this chart out and incorporate the full history of it, which goes back to 1995, you could see the drop in the momentum, while it's been the most severe in the last 10 years, is certainly not unprecedented. The bigger bear markets, like we saw here in 07, 08, in the 2000 to 02 bear market, we saw significantly weaker momentum. In other words, it dipped down lower into negative territory before starting to wind up. Now, typically, once it gets moving to the upside, it follows through. You saw that with all the weak bear markets, shallow bear markets in the last decade or so. Probably the only time we didn't see that was back here in the 2000, very long bear market, which lasted more than 2 years. And you could see it started to turn up and then struggled a bit. And then there was one more down leg there in 02 before finally turning up for a durable bull market. I guess we'd have to watch out for something similar happening here. The current market conditions and the 2000 do have some similarities in the sense that stocks got extremely high valued and high priced going into that peak in 2000. That was the tech stock bubble. When we look at our AWM market valuation indicator, that was the previous high in the valuation indicator. Well, at the beginning of last year, the valuation indicator was even a bit higher than it was in 2000. So that may be a way to understand that this bear market and kind of the restoring of values in stocks may take a little bit longer to play out this time than what we saw from peaks in the market that weren't corresponding with ultra high stock valuations. So we continue to monitor all these indicators. You can see it's a bit of a mixed picture right now with our core indicators. Everything's very neutral with the tactical indicators, very close to the neutral zone. And we do have positive green arrows coming off of that low, officially turned positive back at the end of November last year. So we continue to monitor this uptrend and see if it can't pick up some speed here as we move into the later spring and summer months. So, the stock market peaked now about 16, 17 months ago. And we had, the big down move last year and the recovery so far towards the end of last year into the early part of this year. But all told, stocks are still down, say right around 13%. We're looking at two charts, one of the S&P 500, the other of the MSCI All Country World Index. And the All Country World Index actually a little bit better than the S&P 500. But when we bring growth stocks into the picture, we could see growth stocks are down 24%, about twice as much from the broad market indices, which of course would mean value stocks are not down as much. They're down in the 5 to 6% range. So we're definitely seeing it's not a broad-based major bear market. The value stocks have done much better. In fact, it was just before the March correction that they hit a new high. That's what this indicates of getting back to the zero line. whereas growth stocks didn't even come close to hitting new highs right during this recovery. So different sectors, different opportunities, different industry groups are providing some better opportunities than others. Now recently we've seen a bit of capital flow back to the growth stocks, the big companies, Microsoft, Apple, Google, etc. So we'll see how long that lasts before money rotates maybe back into the value type sectors that if we're going to have an expansion of this market rally, we would expect to see those types of stocks start to carry a little bit more weight. Let's bring small companies into the picture, and they're down, very depressed, in fact, near their lows for the bear market. To us, that's not a good sign. Typically, when we get a major market bottom, the smaller companies tend to lead the bigger companies up off the bottom as money's moving into the faster growing areas, and of course, small companies can grow faster than big companies. So you tend to see small caps perform very strong in a new, bull market, and we're just not seeing that develop this time around. Let's bring the MSCI EFA. These are the developed international foreign markets, and we could see, a much better recovery has taken place, and in fact, has been able to hit new highs recently, whereas the global and the U.S. market has not been able to. And it got down to a deeper level too, so it's really had a strong move up off the bottom. In some videos that we published a few months ago, we showed you that we really do see strength building in the foreign markets, and we do have a lot of our allocations currently in the foreign markets. We think it's something to keep an eye out on, and there may be opportunities over the next, say, 5 to 10 years that are better in the foreign markets for a variety of reasons than perhaps in the U.S. market, which has had a big move and is trading at a much higher valuation than these other markets. And I'm going to show you an example of that in a minute. Let's change the type of chart, and now we're showing percent change, and we're looking at a 2-year time period. And what do we see? Well, we see the markets have made no progress in the last 2 years. The S&P is up 0.62%. The MSCI All Country World Index is down 3.72%. So we've speculated that we're going to have potentially a longer period of time in which it's going to be difficult for stocks to make significant progress. That typically means that we'll experience some significant bear markets, but recoveries, and that's what we got, was a bear market and a recovery so far. But from point to point, May 4th of last year through May 4th of this year, there's not been very much progress at all for a passive buy and hold approach. But typically when we look at those, the S&P 500, the MSCI All Country World Index is still very heavily weighted in the large S&P 500 stocks. And not seeing progress there doesn't mean that there isn't progress in other areas of the market, or there aren't opportunities building in other areas of the market. And I think that's going to be the key for investors over the next, say, 5 to 10 years, is to be flexible and dynamic and be able to identify opportunities in markets or asset classes that are not typically part of a mainstream type of strategy. So I pulled up a long-term momentum indicator for one of the foreign markets, and one I selected here is the UK. Now, not a lot of people think about holding positions in the UK market, but there seems to be something pretty interesting developing here. First thing I notice is it's trading basically at a 10-year high. So it completely recovered the bear market of 2022. Much different than what we've seen in the S&P 500. Now, if we expand this chart out to bring in all the history, I think it shows things that are even more interesting. For example, at the low last year, the UK stock index was basically trading at its high at the end of 1999. So that's over 20 years where stock prices in the UK haven't made any progress. Dividends have been paid, so there's been some return, but price movement has been virtually flat in the last 20 years. And you can see how there's, technically pretty good pattern shaping up here of these higher lows and just beginning to move out of a high that it hit 20 years ago. So when we look at valuations in the stock market, and by seeing high valuations and therefore interpreting that to mean that there's low opportunity or expecting low returns, we're talking about the S&P 500. It's much different than many other types of countries, than other types of industry groups or asset classes that we all have available to us to make allocations to. So it's going to be important to keep our options open, keep our eyes open, and understand when these opportunities away from the mainstream asset classes are developing. I believe that's going to be one of the keys to making progress over the next decade. So as we can see, so far, the three elements that we wanted to see develop to really begin to push this market forward hasn't so far. We don't have a breakout in the market indices. We do not have expanding breadth developing, at least not yet. The third element is we wanted to see some of the economic headwinds dissipate. So let's take a look at the updates for our recession warning models. So here's one of the models. This is the U.S. Weekly Leading Economic Index, and you could see that still in negative territory, has been for quite some time now. Not deteriorating, but it's not improving very much. It's kind of stuck below that zero line, and that's the warning for a potential future recession. You can see the drops below zero tend to coincide with then future recessions, and those are the gray bars on the chart. And then looking at our U.S. Monthly Leading Economic Index, so all these numbers are now updated through month end March. You can see basically the same thing. Negative in the case of the long monthly leading index, very negative. It's the most negative it's been going back about 40 or so years. And they're just kind of stalled out in this negative territory. So to us, we have to expect a recession to develop at some time. It's hard to determine when that's going to happen. It's also hard to determine how severe the recession is going to be. But we think that that is really the big question to determine if stocks continue to slowly grind higher and maybe make a push moving forward, or if they're going to roll over again and there's going to be another leg down in what is then going to have to be considered a very lengthy bear market that started at the beginning of 2022 and ends sometime in the future. So as a result of all the information that we presented here today, we continue to play our cards pretty close to the vest. We're positioned in some growth asset classes that we think have potential to make some progress if the market continues to move forward, if that bull market is able to develop. At the same time, we're holding on to an equal amount of bear market type of asset classes in the form of very defensive positions with a fair amount of cash held as well in our models at this point. And that's the way we'll remain invested until we begin to see some clarity of either the market beginning to roll over again and another downturn developing and we'll shift back into more wealth preservation mode, or that some of those economic headwinds and these other areas of evidence that the market's beginning to move higher start to unfold, in which case we may shift into more of a growth allocation if that happens. That's going to wrap up this update. Thanks so much for watching and enjoy your weekend.